I'm happy to say we do not have anything like the tragedy of 9/11 that we're confronting right now. At the same time, there's a fair amount of pressure on the markets, I think it's fair to say. In this environment, how does one construct a portfolio?
Well, it's not all doom and gloom when we think about portfolio construction. There are ways to build portfolios that are resilient to inflationary environments across asset classes. Now, the typical 60-40 equities fixed income portfolio has struggled this year. But within equities, there's companies that are more resilient, like dividend growers. These are companies that continue to grow their dividends over time. Broadcom's a great example of that. In fixed income, an area that people may not be thinking about if we're approaching a recession is high yield. You can get returns of over 8% in high yield fixed income, so you're paid to wait until spreads tighten, and the companies are higher quality than they used to be. And then finally, outside of public equities and fixed income, look at real assets. Farmland is an area which has built-in inflation escalators often in their contracts, so they can benefit as CPI increases. Also, private real estate. Even the real estate market has issues on the private side. Similarly, leases with built-in inflation protection. Those are key for markets where inflation is going to be increasing.
So, Jim, that's a lot to chew on, but let's start with one of them, which is credit and high yield. Where are you on that?
So we're very constructive on high yield. It's our largest tactical overweight with a yield to worst of 8.5% or so. Downside risk of about a third of the equity markets in the high yield markets. You need to think about high yield as a risk asset. So this is not something we're taking investment grade bonds and putting it into high yields. It's much more of an equity substitute in this environment. But that kind of return looks really attractive here. Another aspect I would mention is geographic exposure within equities. So we have a slight overweight to the U.S. and underweights ex-U.S. and in emerging market equities, really reflecting the significant growth issues and inflation problems that are being realized overseas. That's another way to give clients some confidence that we're positioning for what we think is going to unfold over the next 12 months. And lastly, I would say the real asset side, we also very much support having some inflation exposure, whether it's in global listed infrastructure, which has that pricing power, or on a long-term basis, commodities, where we think you can get in a basket of listed commodity producers a yield near 6%. Which is really attractive in this environment.
So we're actually more concerned about commodities, excluding energy, because we think that commodities are very exposed to demand destruction. But energy is a different story, where supply remains tight, demand should remain strong. And what we love about energy producers is that they're being very disciplined this cycle. They're returning cash to shareholders rather than just working to just increase volume. Good for those companies and to keep oil prices beneficial to them.
But Sarah, put together, if you will, the slight overweight to U.S., not much more than slight that Jim talked about, and what you just said about energy, because given this energy situation, one might say it's more than a slight overweight to U.S. Where are you?
We are probably more constructive on the U.S. than the rest of the world. We think the U.S. will continue to be the safe haven trade because of the resilience of the economy versus the rest of the world. Europe could run into stagflationary issues with their aggressive increases in interest rates while the economy suffers. And the emerging markets are challenged because of the continued lockdowns in China and some of the other areas that are having issues. So I think non-U.S. is going to be a struggle, especially with the strong dollar.
And so I would add to that, from a U.S. exposure standpoint, we also like the energy sector. And the other one that we like are technology stocks. They have really struggled this year, improved the valuations, clearly a long-term growth leader globally. And so it's a bit of a balanced approach within a U.S. equity portfolio, liking both energy and technology stocks.
It's interesting, technology stocks tend to struggle, though, when interest rates are increasing because they're considered long-duration stocks, an area, for example, semiconductors, which have even underperformed the technology benchmark. But I think you can find value in some of these areas. This goes back to dividend growers. Broadcom's a company that within the semiconductor space tends to be kind of offensive and defensive, more resilient business with their enterprise demand and also with their software mix, and a nice dividend that's growing over time.
So as you're putting together your portfolio, do you take into account the possibility, or even some say likelihood, of recession or not? Because, for example, when you say high yield's a good thing. I get a little nervous if we're going into anything that's a real recession, right, Jim?
So you have to have a view on what the recession will be if it unfolds. We're at a 50-50 probability in the U.S., but we think it will be shallow. The banking system is in dramatically better situation than it was during the global financial crisis, so credit creation won't really be hurt. Household balance sheets are not in bad shape, so it's much more likely to be a shallow cyclical recession, and high yield with a starting yield to worst of 8.5% gives you a very nice cushion in that environment. environment.
I agree with that. I mean, we're looking for areas, given the environment out there, where are you getting the best bang for your buck? And so even though we do predict a recession, you're getting paid to wait in high yield with that kind of return. You can have that resilient income producing portfolio in equities with dividend growers, and then look for those asset classes that actually can benefit from inflation, like within real assets.
How important is liquidity in all this? When you start talking about real estate, for example, farmland, things like that, that sounds like I'm giving up something on duration, right?
You're giving up something, you're giving up some liquidity. You're also dampening your volatility. That's why we recommend a balanced portfolio. You want to make sure that you have your publics and your privates within your portfolio so that you do have areas where you can get liquidity if you need it, but also the resilience and less volatile pieces of the private asset classes can be beneficial, especially in this year, which is unique, where the 60-40 typical equity and fixed income portfolios that people have been highly correlated.
All fixed income obviously is not created equal. Where are you in investment grade, Jim?
So we're significantly underweight investment grade. We just don't think that the nominal yield or the real yield opportunity looks particularly attractive. And our number one risk case around sticky inflation, investment grade bonds are not going to do well in that environment. So that's an underweight in our tactical portfolios.
Do you agree, Sarah?
Generally, we would prefer high yield over investment grade for the same thing. You're getting greater returns, more bang for your buck from high yield.
And where are you on tech? Jim said he thinks tech might be a good idea, although, as you said, if the interest rates are going up, typically that hurts tech.
Yeah, I mean, generally, bigger picture, the macro environment is not good for long duration technology stocks. That's why you need to be selective. And we're looking for what we said, kind of offensive and defensive tech together. The companies that either are more resilient because they have healthy growing dividends, or they have pricing power so they can survive the environment. The trade of pre-pandemic, where all technology stocks kind of all did well, I think that's over.
I would just add that the market knows that interest rates are going up and have gone up, and that has killed valuations within the technology sector. So we think that's what's set up the opportunity today. Tech stocks have discounted a great amount of the higher rates.
But it's interesting, if you look at 2023, markets are actually less hawkish than the Fed. So there's a mismatch there. In 2022, markets have now caught up to the Fed's same level of hawkishness. But 2023, markets are saying, you know what, we expect less rate hikes than the Fed expects. And we'll see if that happens. Probably depends on if we hit that recession and inflation finally drops significantly.
We've had this discussion, terrific discussion, but we have not mentioned healthcare or biotech at all, which strikes me, given what we've been through, the pandemic and everything else. What do you think about healthcare?
Just big regulatory risk. So the biotech stocks have been crushed. Now, maybe that will present an opportunity when we've got better clarity from a regulatory standpoint, but I think that's been the biggest headwind for healthcare.
That's an issue for healthcare, but also when people are looking for growth stocks and the tech stocks are out of favor, they tend to go more defensively in terms of growth stock. Healthcare does fit that area. So when you get into these risk-off environments for growth, healthcare can actually outperform.
What about, I mean, you mentioned dividend growers, but what about balance sheets? What about EBITDA, the old classic issues? Are you paying a lot of attention to that at this point, Sarah?
We are, because in an inflationary environment where costs are going up and costs of debt are increasing, I think this is where balance sheets and high-quality companies become very important. Jim mentioned that small caps less interesting. They can be more at risk in periods such as this if their balance sheets aren't as strong and they are smaller companies. So, we think that is a key factor, as well as pricing power. Who's got the pricing power to overcome inflation?
Yeah, so we're a big believer in quality within the equity portfolios. We want to do it on a sector-constrained basis because you can find yourself way mismatched against the overall market. But quality of capital deployment, quality of balance sheet condition, all good things for long-term stock performance.
I say the biggest one for last, and we don't have very much time, China. Should we be concerned about China, the lack of growth in China, Jim?
Absolutely. So we think that the growth initiatives that have been taken have been anti-growth. We think that the zero COVID policy is going to be a problem for at least the next 12 to 18 months until they get their own world-class vaccine, and we just don't see that on the horizon yet.
Where are you on
I
China,
would echo
Sarah?
same thing. I think there's just going to be macro issues there that are difficult to analyze, and that makes it tough to invest in.
At the same time, they could change their course, right? I mean, leading into the part of Congress, I mean, President Xi needs to get the economy going.
Seems a little late to be doing that. I think he would have done that earlier if he was going to do something really big.
And they have talked about that a lot, but we haven't really seen the execution. That's what we'd be waiting for.